When Americans think about big money, they usually picture the stock market, real estate, or whatever crazy meme coin is trending on Twitter today. But underneath all of that lies a financial giant that trades over $7.5 trillion every single day. To put that in perspective, the New York Stock Exchange does roughly $200 billion a day. Forex does that in about 40 minutes. This single, invisible market decides the price of your morning coffee, your gas at the pump, your overseas vacation, and even the value of your 401k. Welcome to the foreign exchange market, the real scoreboard of global power. Here's how it actually works. Let's break it down simply. Imagine you fly from New York to London for a summer vacation. You have US dollars, but London runs on British pounds. You swap $1,000 and walk away with 750 pounds. Now imagine you go back 6 months later with the exact same $1,000, but this time they only give you 650 pounds. The hotel didn't change. Big Ben didn't change. The only thing that changed was the price of money itself. Unlike stocks where you buy a single share of Apple or Tesla, you never buy a currency by itself. You are always betting on one country's economy against another. So what actually makes a currency rise or plummet? The number one driver: interest rates and central banks. Think of global investors as pure mercenary money. If the U.S. Federal Reserve offers a 5% risk-free return, while Europe or Japan offers 1%, where do global billions flow? Straight into U.S. dollars. Everyone buys dollars to park their cash in U.S. Treasury bonds, driving demand up and making the dollar stronger. Factor number 2: inflation and trust. If a country prints money like confetti, citizens and foreign investors dump that currency fast. A currency isn't just paper. It's a direct vote of confidence in a nation's government, debt, trade balance, and stability. For the last 80 years, one currency has ruled them all: the U.S. dollar. Almost everything important in the world, from crude oil to computer chips to global debt, is priced and settled in U.S. dollars. Whenever global markets panic, be it a war, a pandemic, or a banking scare, investors rush to buy dollars. It's the world's ultimate safe haven. This gives America an exorbitant privilege. The U.S. can run massive deficits and borrow cheaper than anyone else because the entire world needs our currency. Is it permanent? History shows no reserve currency lasts forever. First it was the Dutch guilder, then the British pound, now the dollar. Today, central banks are stacking record amounts of gold as a hedge. Now you've probably seen TikTok and Instagram ads promising you can get rich trading Forex from your phone on a beach. Here's the dark truth why over 80% of retail Forex beginners lose money. Extreme leverage. Because currencies move in tiny fractions called pips. Brokers let you use 50 to 1 or even 100 to 1 leverage. A tiny 1% move against you doesn't lose you 1%. It wipes out 100% of your account in seconds. When you trade short-term FX, you're not competing against average retail traders. You're playing against multi-billion-dollar algorithms and institutional banks. The stock market tells you what investors think about individual companies, but the currency market tells you what the world thinks about entire nations. Once you understand how currencies move, you understand the actual game board of global economics. If this made Forex click for you, smash that like button and subscribe for more breakdowns on how money really works. See you in the next one.